Get your free copy of the complete tutorial at www.teachucomp.com/free.
Efficiency ratios are also often called asset management ratios. This is because these ratios give indications of how efficiently a company is managing its assets. Some of these ratios include the accounts receivable turnover ratio, the inventory turnover ratio, the accounts payable turnover ratio, and the sales to total assets ratio. The accounts receivable turnover ratio shows the number of times that accounts receivable is collected during a year. To find this ratio, you must perform two steps. First, you want to find the average accounts receivable. To find the average accounts receivable, add the beginning balance of the accounts receivable to the ending balance of accounts receivable for the year, and then divide that by 2. Then divide the accounts receivable sales by the average accounts receivable to find the accounts receivable turnover. The higher the result is, the more times the accounts receivable is collected. However, you will also want to compare this ratio to industry standards. The inventory turnover ratio shows the number of times that you sell through your inventory during a year. Like the accounts receivable turnover ratio, this ratio is derived from a two-step process. First, you will need to find the average inventories. To find the average inventories, add the beginning inventory balance to the ending inventory balance for the year, and then divide the result by 2. You can then find the inventory turnover ratio by dividing the cost of goods sold by the average inventories. A high inventory turnover ratio indicates either good inventory management or a shortage of inventory. A low inventory turnover ratio may indicate either overstocking or poor sales. The accounts payable turnover ratio is the number of times the company's accounts payable is paid during a year. To calculate the accounts payable turnover ratio, divide the cost of goods sold by the accounts payable. A higher number indicates that the company pays its bills promptly. A low number indicates that there is a delay in payment for some reason. The sales to total assets ratio, also called the return on assets ratio, indicates how well your business generates sales for each dollar of assets at its disposal. To calculate this ratio, divide the net profit by the total assets. You can then compare your ratio to industry standards. If this ratio is lower than average standards for your industry, it may indicate inefficient use of assets.
Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.